Central banks, as you know, are easing, and some say governments are trying to use exchange rates to solve domestic problems. With more on the implications for the currency market, we are joined right now by David Mann. He is head of Research Americas at Standard Chartered. He is a Bloomberg best for his accuracy on forecasts. David, so glad you could be with us this morning. Before we get to the best thing for an investor to do in the currency market right now, I have to ask you, the IMF meeting is coming up this weekend. We've heard the IMF chief, Dominique Strauss-Kahn, essentially say the idea that currencies can be used as a policy weapon is dangerous. Do you agree with that? I'm assuming yes. And then what are the implications for the currency market?
Well, absolutely. I think the key thing to remember with currency markets is it's a rate. So you can't have everyone managing to have a more competitive currency. Someone has to be benefited. But that's
what's happening now. There is this race to the bottom.
Absolutely. And I think this is why we think it's highly unlikely that whether the G20 meeting in November or anything that comes out from this weekend, and the G7 is meeting, though it's becoming increasingly irrelevant in all of this process, we don't believe there's going to be a unified voice necessarily. Maybe there could be some vague terms about talking about how currencies should be moving in line with fundamentals, and excess volatility is undesirable. But ultimately, it's very hard to see that everyone is able to get what they want out of this. We don't think the Europeans want necessarily to have a strong currency. Certainly, it doesn't help peripheral Europe, even though, say, Germany could cope with it. The US itself probably does benefit also from having a relatively weak currency. And we think, given that they're likely to go ahead with pretty aggressive quantitative easing by the latest Q1 of next year and by the end of even by the end of this year, then it's quite likely that that should be adding to dollar negative pressure.
David, we saw a surprise from the Bank of Japan. We talked a lot about it yesterday, and they clearly got out ahead of the pack. But then today, Australia, for example, whose economy looks great by most standards, refused, or just, let's say, declined to raise interest rates. New Zealand in the same boat, also Canada. So it seems like even countries whose economies are stable and growing are almost afraid to raise rates, or just don't want to put themselves at a competitive disadvantage.
Absolutely. I think it's a very difficult situation for a number of markets when they're watching some of the major markets with such ultra-loose policy that what they think of as being appropriate for their markets is such an attractive yield for international investors. And that's where you run across this problem, and it's increasingly becoming an issue in emerging Asia as well, where a lot of the markets there are trying to deal with a lot of the inflows coming as a consequence of being a relatively attractive market.
What do you think of, obviously, the relationship between the U.S. and China is a very complicated one. I'm picking up on this because you just alluded to Asia. What, if anything, can be done, either at the IMF meeting or at the G20, to make both parties slightly less unhappy?
Well, I think what you can see at least is some sort of discussion how the level of global imbalances does need to be addressed, that we do need to see continued increase in savings in the US and less savings in China. But even in that sort of scenario, it's very difficult to see exactly what exactly that's going to mean in terms of any major policy statement. I think the most important thing is to make sure that everyone does make clear that they do want to continue with relatively free trade and with not going down the protectionist route. And we've seen through the crisis, even in the last few years, that has been avoided, we think, to a certain degree. But I think what's happened, for example, with the vote in Congress that we had recently over the so-called China bill is something to be watching out for very carefully. And I think that the Chinese will be looking for reassurances on that.
David, with all of this swirling around, I mean, what are the best currency picks, or can you just not pick anything? Do you have to just be paying attention more to what each central bank is doing? I mean, how do you make investment decisions?
Well, we're finding it very hard to be bringing ourselves to continue to buy the euro at these sort of levels. We probably would prefer, say, you mentioned Australia earlier, longer term, the Aussie dollar, we think, will benefit from the proximity it has with emerging Asia, and particularly with China. Of course, the renminbi we do favor, and you can even now, of course, buy deliverable renminbi in Hong Kong. But I think a key thing to watch for is probably going to be the Indian rupee and the Korean won. We're seeing potentially that certainly the RBI has stepped aside. In Korea also, given that they're looking for seeing currency appreciation, it may mean they don't necessarily hike, but just allow more FX strength.
David, thanks so much for the time. David Mann of Standard Chartered Bank. He is a Bloomberg best.